Like the icebergs that sunk the Titanic, hidden dangers lurk in the murky depths of the American economy. They are as difficult for our economists to see as they were for the captain of the Titanic. Our economy is headed into the wrong direction, and icebergs are everywhere, ready to wreak havoc on us. Let me explain. The major banks hold millions of dollars worth of residential mortgages. These include mortgages already in foreclosure, as well as increasing numbers of non-performing loans, loans on which payments are not being made, which are a conundrum for the banks. If a bank forecloses on a home or agrees to a short sale, a sale at a price too low for the bank to recoup the entire loan balance, it loses money in more than one way. Obviously, the bank doesn't recoup the full amount of the loan, but the larger loss may be the decrease of the values of the current mortgage it holds on the homes in the vicinity of the foreclosed property. This is why, when a house is either sold or foreclosed, the price of the transaction becomes a matter of public record. Appraisers use it as a comparable property when they appraise other homes in the area so that those homes get lower appraisals. As more and more homes are appraised for mortgages or property tax purposes, each appraisal reflects the low appraisal of the others. The ultimate result is a devaluation of the homes in the area. Some banks are beginning to realize the negative effect of foreclosures on their current mortgages, which is making them less anxious to foreclose and more willing to work with borrowers to find mutually beneficial solutions. Unemployment, which a bank can't do much about, is the main reason people aren't paying their home loan bills. So what should the bank do? If a borrower stops making payments on a loan, the bank has to set aside additional reserves to provide for the upcoming loss. If the bank forecloses or agrees to a short sale, the loss eats into the bank's reserves, and as I explained, the foreclosure or short sale lowers the value of other properties in the area. The factor I haven't mentioned with regard to the bank's dilemma is the way the appraisal industry operates under the new HVCC rules, propagated by Andrew Cuomo of New York. I've written about the serious problems this new law has caused, but I'll put it in perspective for this discussion. In a refinance under HVCC, the appraiser isn't told the size of the loan, the type of refinance, lender, or in many cases, hasn't even worked in the location of the property. In a purchase, the appraiser knows the price, but not the down payment or loan size. Appraisers have been criticized severely so that their inclination is to bring the values of loans in as low as possible. There isn't any incentive for them to seek a middle ground because, unlike in the past, they are hired by third parties from whom they have no reason to expect more business. The National Association of Realtors reports that these low appraisals have caused a great number of sales to fall. Note, now as in the past, a lender can question the appraisal by doing a desk or field review, checking an automated value module, or all of the above. Another issue banks face is whether or not to grant loan modifications. Most banks will only consider loan modifications on owner-occupied properties. Furthermore, they won't begin to discuss the modification with a borrower until the payments are late. They will only modify a loan if the borrower can show sufficient income to make the payments. Essentially, loan modifications are reserved for employed borrowers whose interest rates are high, but who can't refinance the mortgages because of their credit, high loan-to-value, or insufficient income, and are behind in their payments. Usually under these circumstances, the lenders will modify the payment, the balance, or both on a first loan, but not a second mortgage. The number of loan modifications are extremely small in relation to the borrowers in need of them, and influential in comparison to, inconsequential in comparison to the total mortgages outstanding. Once a borrower gets a loan modified, he may be faced with a new problem. Credit card issuers usually check on a borrower's credit, and missed payments alert them to credit problems. They'll cut off the borrower's privileges or lower his limits immediately. As a result, we'll have a new class of working citizens who are unable, if willing, to make the new purchases that drive our economy. How did this happen? The borrowers needed to miss their mortgage payments in order to get their home loans modified. The administration doesn't appear to be at all concerned about the real estate industry. Rules and regulations arrive weekly, ruling it increasingly difficult for would-be borrowers to qualify for loans and forcing those who are self-employed to continue to find some alternative form of home financing. With the reset of the option arm, known for its 1% start rate, staring us in the face, along with the aforementioned problems, we're facing the tip of some rather large icebergs that could eliminate any chance of a quick and lasting recovery. Remember one thing, when your neighbor loses his house to foreclosure or short sale, your equity is diminished. And that's why, like it or not, we are all in this together. I'm Roger Schlesinger, the Mortgage Minute Guy.